And I hope you do the same with your business ideas, because if you make a community, then you can grow that business 10 by 10 by 10, which is how things like Facebook grow, or things like Twitter, one person at a time, or 10 by 10, which is 10 at a time. So what about all the free money? And this is Matthew Lesko. He's my nemesis. I cannot stand him because he gets up on the TV and shakes his book and says how great it's going to be. But what does Matthew Lesko promise? He promises that there's free money to pay your bills. Yes, there is. Free money to pay your bills. But I bought his book, and I bought some of the other ones out there that promise free grants. And when you get to the business section, they're usually full of loans and loan programs. The grants themselves are things like social services. So if you're poor enough, yes, you can get money to pay your rent. We all know that. But do you need to pay somebody for a book to be told that? No. So I can't stand it because while there are grants available for small businesses here in North Dakota, they're limited to things like technology. They're limited to things like agriculture. They're limited to things like daycare. And usually they're so specialized that so few people qualify. And once you do qualify, the funds are restricted to such limited use that they become not useful hardly at all. Certainly not to start and grow a business on. Maybe to expand a business. So nobody's going to walk up and give you a check. So what does that mean? That means you have to go get your own money. That means that you either have to get a loan, and in loans we have conventional loans, which are non-government loans. We have government guaranteed loans. We have government participations. We have low interest loans, like the PACE program here in North Dakota, which knocks about 5 percentage points off of a loan, only for primary sector businesses. And we have term loans and lines of credit. We have gap financing. Gap financing is essentially what economic development agencies do. Why is it called gap financing? Because they're not going to give you all the money you need to go into business. They're going to fund the gap. The gap between what the bank is willing to give you and what you're bringing yourself through equity. It's limited to 50% usually by federal law, and generally it's like 10%, and sometimes even less. And I get tired. I get tired because you see these news articles, right? Where it's like, oh, the state of North Dakota invested X million dollars in this place in free money, and it's almost never true. It's almost always participations and low interest loans, and it's like alien technologies when that failed. It looked like everybody lost billions of dollars. I think, what did the EDC lost? Maybe 90 grand?
We didn't. We got
Not even? You got your money back. I'm glad that you're here. So you would have lost 90 grand and they paid you back. And it's so frustrating because people think that these people can give them all the money they need, and then when these companies fail, or if they fail, they think they're at fault, and that's just not true. They're really a bit player within the entire industry. In order to even qualify for these funds, you need to be primary sector, which in order to be certified here in North Dakota, 75% of your sales need to come from out of state, which means you can't sell pizzas to the local people. You can't sell insurance, right? You have to have something that's sold nationwide, perhaps even globally. Job creation, they have requirements of anywhere usually between $10,000 that they'll give you per job and up to $75,000 per job, depending on the program. And then finally, we have target industries. In particular, I don't know what yours are. Probably biomed and what else?
Well,
value-added agriculture.
We do just primary sector, but yeah, the state has their...
That's right, I'm sorry. Department of Commerce is the one that has this. And then finally, if you're in a small rural area, essential services sometimes qualify for these, so grocery stores, gas stations, etc. And again, it's less than 50%. So finally, we have equity, and by equity here I mean angel investors and venture capitalists. And angel investors and venture capitalists are also looking for businesses with a nationwide market, but they're also looking for high-risk, high-return businesses. And this is actually a map of all the available funding to entrepreneurs, from startup businesses to mature companies, low risk to high risk and high growth. Okay? so down here we have startup companies with low growth. We have micro loans, which Lake Agassiz here in town does micro loans. RLF, Lake Agassiz also does that through a different division. That's rural loan funds. This is only for rural businesses. There's friends, family, and fools, right? The people that you don't have to pay back when they give you money. There's founders, the cash that you put into the business yourself. There's your sales. Once you get launched, you have sales. And then up here, SBIR, which I disagree with because SBIR should be shifted over some. It's pretty rare for startups to get SBIR. But up here where this red spot is angel investors and early stage venture capitalists. Do you see how high they are? High risk, high risk, high growth, high growth. They're not interested if you're not going to be the next Facebook or the next YouTube or the next whatever. In the middle here we have individual angel investors. These are usually value-added angel investors, people who are also going to consult you as you start and grow your business. Venture banks, early stage venture capital, and then finally private equity, IPOs, and the like. Here's where they put commercial banks and the SBA, but I would love to take SBA and put them all the way over here because every year we get startup businesses SBA. Every year. We've never done less than $8 million a year in startup SBA loans. I mean, Mike Page was $3.5 million, and that was a startup business. You can't tell me. I get so tired of these pundits on TV saying SBA doesn't do startup funding. That may be true in other states, but here in North Dakota, they do startup funding. In fact, banks won't do a startup usually without an SBA loan because they want that guarantee. They want that protection. So if you're going to go for an SBA loan or any other type of loan, what do the banks look for in your loan application? It's not like going for a mortgage or a car loan. It's not just your credit score and your income. Yes, they do consider your credit score, and generally if you're a 700 or better, you're probably okay. If you're under a 650, you probably need a cosigner. And then if you're somewhere in the middle here, we call this VC credit, and you might need a cosigner, or maybe they're just going to charge you more interest or give you a shorter term or whatever the case may be. Capital, the amount that you put in of your own money or of an equity investor's money, 10% is the minimum with most of the programs, 15 to 20% in your golden. Sometimes you'll walk into a bank or you'll hear on TV, oh, if you don't have 20 or 35% down payment, they're not going to give you the money. Baloney. Baloney. I've never had a loan go over 20%. I had one, and it was a off sale. They leased the building, they leased the equipment, you have to pay cash for liquor, beer is 7 days. How much collateral is there in that? Nothing. And the bank said, yeah, we'll give you 65%. You come up with 35%. That was the one time I went over 20%. One time. Collateral, obviously fixed assets such as equipment, building, etc. That secures the loan. But government guarantees can boost that coverage so the bank doesn't have as much risk out there. Your capacity. Where do you think they come up with the capacity to repay debt on a startup business? Probably the business plan, right? So why do we write a business plan? Because then we have financial projections which are based on assumptions, which then they can look and say, does it have a debt coverage ratio of 125% or more? What does that mean? That means after you've paid all of your bills and you've paid yourself, because you're not going to work for free, does the remaining income that the business make exceed 125% of the debt payments? So if annually you have a $10,000, you take your monthlies times 12, and it's 10 grand, they want you to make $12,500 or more after you've paid all your bills and you've paid yourself a reasonable salary. So they want a little padding. And then character. What kind of education, experience, background do you have in order to make this successful? And finally, the conditions of the loan. And again, this is not a checklist. They don't go boom, 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 you get the loan. What they do is they say, oh, you don't have a lot of collateral? Perhaps we'll need more equity. Okay? Your credit score isn't so hot, we might raise the interest rate on you. Right? So it's not a checklist. It's just a weighting.